So, Ryan Kirkpatrick from Colorado Impact Fund is going to be with us tonight. Ryan's got a BA in molecular biology from Princeton, which caused me to open my eyes a little bit. His MBA from Wharton. He's got considerable PE and VC experience. Is Bruce here, or is he? Bruce, okay. Bruce Dines is making his way up. He is the president of, currently he heads up the VC arm of Liberty Global. He was the president of a $200 million company previously, COO of a $45 million enterprise. His specialties are VC investing, M&A, and all kind of skills that go with that. Chris Marks, gentleman on the far right. Chris. Hello, testing. Try this again. Chris Marks is with Tango at High Country, also part of a new fund at Balloon Oak Ventures. Did I get that correct, Chris?
Yeah.
And considerable experience. Also was an attorney at Hogan and Hartson before I went to the light side of things. And last, we have Brian Wallace from Access Venture Partners, which does primarily early stage investing. Brian is a managing director with Access. Hello? Okay, I'm sorry. This thing is, may need to get a different microphone here. Brian also has his law degree and was previously an attorney. Sorry about that. I'll jump right in, guys, and I'm going to go ahead and start with Chris. And in terms of kind of inception and business plan, what are you looking for? What gets your attention typically with all the business plans that you see and get you willing to talk to somebody and see if there's a fit?
Sure. I think if I turn my mic on, yours goes off. Just
got it.
So that was me torturing you.
Perfect.
But anyway.
This is tech guy. But
Right. So, sure. So, can you guys hear me? It's like, you guys turn yours off, maybe.
Yeah.
There you go. We cannot speak at the same time. If I go too long, just turn your mic on. So I invest in early stage technology companies. That's what I've done at all the various places that Pat listed up there. So when we get business plans, and we get a lot of business plans, they're generally early stage, so we do not spend a lot of time looking at revenue numbers. We do not spend a lot of time looking at forecasts, although those are important, but we take them with a grain of salt because generally our companies don't have a ton of visibility into the future at the point we make our first investment. So we spend a lot of time looking at other things like size of market, the underlying technology, and predominantly just spend time with the team and the founders of the company and try to understand what their vision is, what they're trying to build, what kind of people they are in terms of some of the characteristics that we like to see in entrepreneurs and some of the things we think will help solve some of the problems that will inevitably arise in those first few years of building a company. So we spend a lot of time assessing those things as well as kind of what you would expect to hear in terms of business plan, financial model, economic model, market size, all that kind of stuff.
Let's get another person.
I'll let you talk.
This is going to be amazing to get through this. Let's get another perspective on that. Ryan, is that a similar approach from your vantage point?
Yeah, we're structured a little bit differently, have a little bit different strategy, but a lot of the fundamental components are there. We're more of a little bit later stage investor. For us, what's key is that the company is past proof of concept, and that means different things in different industries, but I think the rule of thumb for us is product or service that's on the market that is generating revenue so that we can diligence those customers. So we're slightly different risk profile than probably Chris. And also we're an impact fund. So while making really good investments is important to us, and we hopefully use the same discipline in analyzing and structuring and underwriting these deals, we also, it's important for us that the company's product or service is helping our communities in a positive way. So we look at deals in community health, education, conservation of natural resources, and other businesses that are helping to improve economic development. So impact is also a key piece of the puzzle for us. So that's really our initial screen, and then we do a lot of the traditional work that Chris is talking about, which is how big is the market, have they figured out the product market fit, and really, we'll all probably say it, but it really, the fit with the team, the quality of the entrepreneur, that's really very, very important to us.
Bruce, let me see if you can pick up where he left off here a little bit. So can you talk a little bit about management team and how you assess potential market in your investments?
Sure. I mean, one of the things. Oh wow, how about that? Yeah, high tech. Look, I think it's hard in this extremely competitive world that we live in to win, and it's only getting more competitive. The cost to start a web-based company today is about 1/20th of what it was 10 years ago. And so when barriers to entry decrease, and you guys, I'm not even going to go into the whole story about IP, but you can't really value IP in the same way that you did 10 years ago either. So when you see kind of these barriers to entry that come down, it really is all about execution. There's no lack of new ideas in the world. The hard thing is getting those ideas from concept into the marketplace. And so when we do early stage investments, and we're pretty much stage agnostic, we're a corporation with a corporate venture arm, and we're much more interested in relevance to our core business strategy than we are in stage of company. So we've invested at very late stages, kind of Series E, Series F. We've also seeded and incubated companies when we think that they're onto a technology that is promising. The early stage stuff is very, very different. And I almost always assume that there's going to be management changes. Because oftentimes, particularly the entrepreneurs who are young, they have capabilities to get the company to a certain level, but they just don't have the seasoning and the experience. They haven't seen enough, particularly of this competitive environment that I've talked to sort of easily navigate those waters. And that's oftentimes where it's important to bring in somebody who does have more seasoning and who can work well with that founding CEO. But mainly what I look for is how are you going to win? And one of the mistakes I see in a lot of business decks is people don't talk about that. They talk about market size and how they're going to capture their 2% share. But what's the execution plan? How are you going to win? What's your differentiator? And I think that's really important to focus on, especially in today's environment.
Brian, so with that, how important, I guess, would you say experience of management team is? And if you are not experienced, if it's your first venture, what are sort of the key attributes you'd say, this is somebody that can make it, somebody I want to get behind?
That's the toughest question. There's so many different types of entrepreneurs. I'd say if you look through our portfolio of the things we've done well and the companies that have done well and the ones that haven't, I think the product vision and, you know, Bruce alluded to and sort of Ryan, the product market fit. And typically the best entrepreneurs are those that really own the product. And it doesn't necessarily mean it's an engineer. It doesn't necessarily mean it's, you know, the person who actually runs product, but it's someone who has, you know, a passion and the vision for where that product is going to go into the market. So I would say that, you know, of our successes when we're right on that, that there's an entrepreneur within the organization, and they come in all shapes and sizes. We've had success with first-time entrepreneurs and, you know, 5 and 6 times entrepreneurs. So it's hard to say with the product person. Now switching that to, you know, how you build the team, that's a whole, you know, different, you know, exercise. But we're willing to make the bet with young product people who don't have that entrepreneur experience and build a team around them. It's you know, they're all human chemistry experiments. You can get really bright people in the same room and put them all together, and sometimes it works, sometimes it doesn't. But if you don't have the product visionary who just really is going to make that happen, those are the ones that we typically miss on.
Ryan, question for you that comes up, I know a lot with what I deal with, and I've got my own perspectives on this. I'm curious what yours are. Valuation, my opinion, is highly overrated for entrepreneurs, I should say, and something that there's way too much focus on, particularly in early stage. So could you talk a little bit about what your approach is to that? In early stage, you're talking about pre-revenue, big ideas, pulling a number out of a hat. What would sort of your recommendation be based on the way you guys look at deals for, you know, folks that are looking to get funded?
Yeah, it's kind of a tough question. I mean, I agree that valuation is certainly overrated in many respects, especially if you're an early stage investor where you know, the idea is much more conceptual. It's not on the market yet. There are not a lot of proof points. You know, very typically, those types of investors who are taking a lot of risk expect really great returns to be successful. And so I think if that's your kind of risk, you know, if that's the risk profile and you're expecting big early stage venture like returns, I think you're right. I don't think the valuation matters that much. For a firm like ours, who's a little bit later stage, we have to be a lot more comfortable on the valuation side and a lot more careful because we're not taking as big of a risk, but our expectations on the valuation side or on the exit side are probably not as high, and so the volatility within our portfolio has to be less. We can't have a lot of zeros. We need a lot of, you know, between 2s and 5s, and I think with that kind of risk profile, we have to be more careful. But the good thing is that there are a lot more proof points when we invest, and so it's a lot easier to kind of pinpoint that valuation than it is maybe if it's just you know, an idea or a concept.
Chris, BQ, we talked about sort of the deal size that you do, and you'll start at a couple $100,000. So what's your perspective on that?
I agree with what Ryan said. I mean, you know, it sounds a little self-serving when the investor talks about valuation being irrelevant. I would say, you know, my advice to entrepreneurs is often, you know, look for the right investor versus the highest valuation, because the right investor is going to give you a much higher likelihood of success in the long run. And I think where a number of early stage entrepreneurs go wrong is that they fight for a really high valuation in their seed and early stage rounds without kind of thinking through where that takes them in the future. And the hardest financing to get done right now in this market, but I think across the country, is Series A financings. So people go out and kind of beat their chest to get a higher valuation on their seed round, often then are just putting up an additional barrier to getting done what's already a very hard financing to get done. So, think long-term, think about who you want as the right investor, and know that if your company's gonna become what you think and want it to become, you're not gonna win or lose based on the valuation of your seed round.
Yeah, I would just add to that too, that when you raise a seed round at a super high valuation, the expectation that sets around our return profile, I mean, you really have to understand that. Because all of us underwrite to a certain return threshold. And so if you're raising money early on at a super high valuation, what does that mean in terms of your exit value? And is that actually achievable? Is that actually realistic? Because I think having that really good alignment with your investor early on is super important. And so I think understanding that dynamic around entry valuation and exit and what that really means about your business when you exit is important.
Would the two of you say that's consistent with your approach? I mean, this is an important one. I mean, this comes up all the time, so I'm just curious. And Bruce, is this different sort of with Liberty, for example? Or is it kind of similar approach?
Well, John alone made all his money by investing at low valuation. So there is a negotiation that takes place, and it's a seesaw, it's back and forth. And the right answer is it depends. It depends on the vision, it depends on the market size, it depends on the potential to build, sort of protective moats around the business above and beyond first mover advantage and above and beyond IP. And it depends on the track record of the entrepreneur. I guarantee you that entrepreneurs look, the reason that, Bessemer and Benchmark and Kleiner and Draper and all those guys raise multi-billion-dollar funds is because they're investing in entrepreneurs that have been with them before and have provided them with handsome exits. And those entrepreneurs will drive a premium valuation on their deals. But in general, yes, I agree. Being an entrepreneur is really, really hard. I'm sure many of you out in the audience know that. And I think the important thing is to find an investor who you feel really comfortable with, who you feel is going to be supportive, and not, continually shoot arrows at the plan, understanding that the plan's going to need to flex and move and change with market dynamics and as the business unfolds. And understand that it's binary. These outcomes, there's three outcomes, right? You fail. If you're going to fail, then fail fast. You succeed, and a measure of success is you have an equity return, or you get stuck in this really miserable middle ground where your company's making $15 or $20 million a year, and you can't find a buyer for it because you're not growing. And so then it's a whole process of pivoting and figuring out a whole new plan. So the outcome on the seed stage, it's not material to your wealth creation and your success as an entrepreneur.
Yeah, so just a couple points to add. When you approach a venture investor, the mistake a lot of entrepreneurs make is you focus on negotiating the deal before you've sold them on your business. So I think the most important thing, we won't engage with an entrepreneur if they're just going to talk about price and valuation. I said, I don't know how much I want to value your business at. I don't know what I want to pay for your business. I don't know if I like you or your business. So let's talk about the market. Let's talk about your product. Let's talk about how you're going to kick ass. Let's talk about how passionate you are. Then let's talk about it. And guess what? The more I fall in love with your deal, the more I want to ask you to prom, the more probably I'm going to pay for that deal. So create competition through selling your passion and your business, not the value. And as Warren Buffett says, price is what you pay, value is what you get. And I don't know what the hell that means actually, but I like to quote Warren Buffett as many times as I can. But to pick up on Ryan's point, I mean, we all invest at different stages of this, but think about public markets and public companies. Their stock goes up as they demonstrate growth. and momentum in the financial markets. We're no different. And you should be the same as aligned as we are, that if you're going to do a seed round at X value, you've got to show what are the later stage investors, or the A round and the B round, what are they going to pay? What are the typical valuations there? And you better build in a 2 to 3x markup for your seed investors. When we invest into Series A, we go talk, the first thing we do is we'll go talk to 5 to 10 Series B, Series C firms and say, do you like this market? If a company would do, put a product or service out in this market, would you invest? What would they need to do as far as revenue for you to invest in the company? And then you say, okay, well, they're going to pay about a $40 to $50 million pre, just to throw a number out there. Well, we're not going to pay more than a 15 to 10 million or 15 to $20 million pre to build in that 2 to 3x markup. You got to have momentum, and you got to have increasing valuations, no matter how much capital you raise. That's how you get reported in TechCrunch for financing. It's because it's a huge up round, not because you raised X number of dollars.
Great advice, and you just made a really important point too. Your network with the right investor is huge. I think a lot of times entrepreneurs underrate the fact that you get the right investor, they can take it to Series B, Series C, which is really powerful in and of itself. So, you look like you wanted to respond. No, okay. All right, I'll go back to Bruce on this too. As an investor, you got to look for an exit of some sort. How do you go about, and what do you recommend in terms of kind of finding the right alignment? For a lot of founders tend to go, I really want to build this is my baby. An investor, you're obviously looking to make a substantial return. So how do you recommend kind of bridging that gap, or how do you go about it?
Yeah, how about if I just say I don't really give that much thought. I just want our teams to focus on building great businesses and flexing with the market and building really strong teams. And if they're successful in doing that, the business will take care of itself, and exit opportunities will come. Now that said, I think there are certain times and certain moments when it looks like there's increasing competition. All of a sudden you've got a Google or an Apple or a Facebook who jumps into a category that they hadn't been involved in or engaged in before through some acquisition. You happen to be in that space, and you're sitting there wondering, is this company going to be able to successfully compete? Those types of situations and scenarios, then yeah, I think you have to sit down with the team and say, maybe this is, it's better to take a bird in the hand at this point and move forward with some kind of M&A transaction.
Please.
So I can cut you off. So just to follow up, because I disagree with Bruce on a couple points, because we go way back. Bruce mentioned that he generally, when he invests, anticipates some sort of management change, and I think that that's a reasonable assumption. Although, from our standpoint as early stage investors, we really only invest if we think that the people we're investing in can take it all the way. Now, does that always happen? Of course not. There's very few people that can thrive as an early stage CEO and then thrive as a large company CEO. We get that, but we try and find people who we think can. That's a really long road, and it's a really hard road. And so I tend to have that conversation early and often with the entrepreneurs that we work with, in terms of sitting down with them and really painting a picture of what that looks like from both a lifestyle standpoint, as well as some of the sacrifices they're going to need to make to get there. Because you don't need to be in this business long or to have many investments until you realize that when you get misaligned with your entrepreneur, you don't stand a chance of succeeding. So if his number one or her number one stress is being able to move into a bigger house, or, being able to put their kid through college, or whatever it is. I like to know it, and I like to work with them to come up with something that works, versus getting them to a point where they're going to break and have to make the wrong decisions. So from day one, when people come in and pitch us, I, in a way, try and talk them out of taking venture capital by explaining kind of what the expectations are, what that road looks like. And then if we get serious and we do make an investment, then we definitely sit down and have the conversation about, where their vision's going, how we can be aligned in terms of achieving some of their goals along the way, and how we can really be aligned for the long journey. So that's a conversation that we really try and have.
Chris, I want to stay on that. Why VC money might not be right for a lot of businesses. So tell us a little more about that conversation and why that's the case.
Sure. So, VC money comes with a lot of expectations. You're listening to us all talk here about the return metrics and the hurdles that we need to clear in order to be successful venture capitalists. And we all have limited partners who've invested their dollars with us and expect a return from us. So, people who come in and again, this is a reason for the conversation, and say, hey, we only need a small round of investment, and we're going to get cash flow positive, and we're going to have a great business. Well, you don't need venture capital then, because we need to invest in companies that are really committed to high growth, fast growth, dominating in their space, and driving towards a large exit. That's how we make returns for our limited partners, and are able to raise another fund and move on. So with those demands come a lot of obviously different dynamics for entrepreneurs in terms of expectations, growth expectations, spending expectations, future capital raising, etc.
So I want to ask two questions of each of you and then move to questions for the audience. I'll start with Brian. Is there any sort of specific advice that you recommend to entrepreneurs that are out here seeking funding? And then the other question is, how many deals do you look at, and kind of from a percentage standpoint, how many of those get funded? And then I just kind of like to move down the road. Thank you.
Well, I can answer the question backwards. We do probably 4 to 6 deals a year, and we probably are working. Where all partners are actively engaged in some form of diligence with anywhere from a half dozen to a dozen companies at a time, and we probably have another 30 to 40 where we're a couple of us are dealing with them, and we probably have another 100 to 200 that are new opportunities each month. So when you do the math, it is whittling it down quite a bit. So that's just a numbers game, and I'm not here to say that those 100 to 200 opportunities that we're taking meetings and doing a lot of diligence. I mean, we do sleep and have families and lives. It's just that there's a lot that comes in, and so advice to entrepreneurs is recognize that. And how do you get noticed? Well, the best way to get a plan to a venture partner is not to send it by email. That's about probably the lowest. The best way is to come through someone like you, or someone who, a trusted advisor or someone who knows, and get it introduced to that person, either through someone that they know, another entrepreneur, service provider, a trusted source. That's how most of our deals, come to us. And, to echo on Chris's point, don't be afraid to, ask honest questions, both when you do get meetings and before you even get meetings. I mean, venture capital is right for, just the smallest fraction of businesses. It puts unreasonable pressure to grow your company. And, when you put unreasonable pressure on any system, whether it's the pipes in your house or your business, it's going to break. And we're really good at breaking businesses because we need unreasonable growth. And when they work, it's great. But, our last portfolio of 16 companies, 2 of the companies are going to drive 95% of the returns. You know, and it's not that we ignore the ones that don't work, but we put all our capital behind the ones that work, and that's the model. So the advice I give is just make sure you really want to go down that path, and then make sure that you network and get introduced, and do your homework on who you want to work with.
Great advice.
So I literally was just looking at a financial model today, and I noticed this line item in the financial model that said quarterly distribution, and I thought to myself, well, what's that? and so I looked at it in year one. It came in about 3% of revenues. I said, okay, not a big deal. I went to year two. Anyway, I got to the out years, and it was a couple $1 million and like 18% of revenues. And I thought to myself, well, that's not going to fly. And I really like this business. So the conversation I'm going to have with the entrepreneur is, what do you want? Do you want to build equity? Do you want to take cash out? If you want to take cash out, we're not the right partner, and there's other ways to go about getting your business financed. If you want to take your vision and build equity and have a longer-term exit, then we can sit down and have a discussion. That's another very good example of where venture capital might not make sense for the business or for the entrepreneur. And it's not that it's a small business. This is a big idea, and it's got some very interesting traction in the marketplace. But it still might not be a fit for venture. And I'm sorry, what was the other question?
Any advice for entrepreneurs looking for VC money?
Yeah, my best advice is if you aren't absolutely passionate and absolutely laser focused on building this business, if this isn't something that is like in your blood, you go to sleep at night thinking about it, you wake up in the morning, it gets you excited, it gets your adrenaline going, then don't do it. It won't be a great match. And either, even if you succeed in raising venture capital, you'll end up in a different role, which not necessarily a bad thing. But one of the things that I think who's been in this investing business for a while understands, it's almost a sixth sense about how entrepreneurial somebody is. My own belief, and I'm sure these guys would debate with me, great entrepreneurs are born. You can build good entrepreneurialism. I was an entrepreneur, and I would give myself a kind of a B. I've met guys who could run circles around me as far as being entrepreneurs. So if you sense that that's really who you are and what you want, then absolutely go for it. If it's not, then I would encourage you to reassess.
Yeah, so on our hit rate, we launched in July. We've made 2 investments. I think we've probably looked at 150 opportunities. I'd say about 50 of those probably were just a little early for us, and I would put those in the category of still interesting. And so maybe no's now, but maybe not no's later. So 1 out of 50, I think, probably so far is the hit rate. Advice I'd have for entrepreneurs, it's interesting. I think. And these guys might shake their heads at me, but I think it's really persistence. I think if your business, we're going to say you're going to hear no a lot from people like us, and I can tell you that in these first 2 deals that we did, we said no the first time, and they came back and proved out some milestones, and the environment changed for that opportunity. And so don't take no for an answer. If you're really passionate about your business, if your business has great potential, don't let a no discourage you. Just keep at it, keep moving the business forward, keep demonstrating to people like us that you can execute. Because I can tell you, we move a lot faster and can make decisions a lot more quickly when we've actually seen a demonstrated track record. And so I think oftentimes for us, those are the best deals where we've made that connection early on. The entrepreneur demonstrates performance, and then we can move really quickly. I think that happens a lot. So don't take no for an answer. Don't pester him too much with emails.
I can assure you, you're going to regret that statement. Someone in this room is never going to let you forget that. I would only have one thing, and I won't go into our how many deals we do is similar to these guys, so the numbers are not great, but don't want to be discouraging in that sense. But I would say the one piece of advice I'd give to try and offer something a little different than these guys, all of whom I agree with totally, is the biggest mistake I think a lot of entrepreneurs, particularly young ones, make when they come in and pitch us is thinking they need to have all the answers. And it's, you're not supposed to have all the answers, but that's really hard to know. And we don't want you to have all the answers, nor do we expect you to have all the answers. But self-awareness is something, when we look at the traits that we want our entrepreneurs to have, is at the very top of the list. And if we think that it's going to be hard to break through that, and that working with you is going to be a series of, yeah, everything's going great, I'm killing it, the business is great, until the business is horrible, then that's not going to be a great fit for us. So I always try to get to, as you can probably glean from my comments, and always try and assess how much transparency is going to be in the relationship, how much self-awareness people have. It helps in hiring. People who are more self-aware are going to hire a stronger team around them. So don't think you need to have all the answers. Come in and have an honest discussion about your business. And I think it'll be much better received by any of us up here.
Questions?
So Bruce, you had mentioned that there are 3 options for any company, which is you either fail, hopefully quickly, you can succeed, or companies can languish. And that's the same for early stage companies too, not just later round companies once they get past the initial VC, A, B, whatever round. What do you do with companies that are languishing? What do you recommend to the CEOs? What actions do you actually take to interject to make a difference to those companies? Because you don't want a Deadpool, I'm assuming.
Yeah. Well, it's languishing for a reason, and it could be lots of things, right? Obviously top line growth is suffering. But it's an analytical process. Is it the culture of the company? People are disincentivized and demotivated. Is the sales commission structure upside down? Do we have the wrong people sitting in the wrong seats? Does the whole strategy need to be reviewed? And oftentimes it's a combination of those things. So it's roll up your sleeves and really dig in and understand the current state of the business very honestly, and then figure out what steps you think you need to do to move them to another level.
I've heard from a few VCs in town that I'm simply too old to be funded. Give me your non-politically correct answer. Am I too old?
You know something? My non-politically correct answer is bullshit. I mean, look, maybe in Silicon Valley, and maybe if you came with the latest security, endpoint security technology, if you couldn't speak to that in a really cogent way, it would potentially be problematic. But no, I think oftentimes folks who have a lot of experience are at a stage in their life where they want to go back in and do something brand new. They're not the retiring type. They're not ready to retire. I think that's a great position to be in, and come at it from that position of strength. You know, this is who you are. So that's my sense.
The rest of the panel?
We've invested quite a few times in the past, at least I have with Tim Draper, somewhat of a famous venture guy. And he says he'll never invest in anyone who's over 35 years old, and he's only broken that rule when he's found an entrepreneur that he really liked in a deal that he really liked, and he's invested in anyone of any age. So it doesn't matter. There's no one sitting around saying, "Wow, that person is way too old to do this." Now, there is an insanity factor for someone who wants to be a startup entrepreneur, and I would never do it at this stage of my life. Bruce wouldn't do it again, and he's a lot older than I am.
Well, it would be David Gold who's told me point blank that I'm too old to be invested in.
Well, that sounds like something David would say. David's my partner.
And I would probably agree with him because he questioned my stamina, which is obviously not as good as it used to be. And the motivation is a little, it's not there. So I asked this question not in that I'm disagreeing with Dave. I'm halfway there. I'm just wondering what the panel has to say, looking at the relative age of the audience.
Yeah, I mean, if I were talking to you, I would not, age, in my mind, can be a real positive in terms of experience. But I would ask all the same questions that you're alluding to. How are you really in this for the long haul? How much do you need this? How hungry are you to get this done? We've had a bunch of, we get a bunch of entrepreneurs who come in and say, I've been in big corporate America my whole life, but suddenly I feel like this itch to go start something. That rarely works out well. Go dip your toes into it for a while and see if you really like it versus getting 6 months into it and realizing you hate it. So I don't think it's an age issue, but I do think experience is really important to us, and just again getting back to kind of aligning with the investors and making sure you're on the committed to the same path.
If you were, like me, motivationally questionable, stamina not great, how would you look at forming the rest of the team? What would you do?
Well, I think, finding other people who share your passion and vision but are really committed to it and have the motivation and incentivizing them the right way, and maybe assuming a position like chairman or advisor or board member.
So what I've just...
Well, I think
Praful has told me that I'm too old.
Paul, we're going to have to cut you out there. We got to go to the
Oh, okay.
I got a great question. All right, I think that's all.
We got to cut it off. I'm sorry. Thank you, everybody. This is awesome. Appreciate it.